Hello there. Welcome back to grade 12 accounting. In this video, we want to look at a March 2017 common test, and it's from the province of KwaZulu-Natal. So we are going to start on the first question on that question paper. So before we go to the question paper, we can go through our instructions. So the instructions are very important within the context of this video. Is we should answer all questions on instruction number 3, answer all questions, and then we go to instruction 8, which is all calculations where applicable must be rounded off to 2 decimal places. So we can just take a note of that, and we can see that our questions. For the first question, we got a question on calculation of ratios and audit report. Then the second question, interpretation of ratios. Third question, financial statement, and then on the last question is on cash flow statement. So going to our first question on ratios. Our question reads: you are provided with information taken from the books of Ingus Limited for the financial year ended 28 February 2017. This company is listed on the Johannesburg Security Exchange, which is the JSE. On the required part, calculate the following. First part, return on average shareholders' equity. That is the ROSH with 5 marks. So obviously, we need to find out about the formula for calculating return on average shareholders' equity. But remember, when you're calculating return on return on average shareholders' equity, the formula is net profit after tax. Then we divide by the average shareholders' equity. So going to our answer section, we are saying it is equal to net profit after tax, and then we divide by average shareholders equity. So this is what we have in terms of its formula: net profit after tax divided by average shareholders equity. So according to the information that we are given, we just need to find out about net profit after tax. So we go to the information given in the question. We're given information A, of which we are given list of balances for 2016 and 2017. 2016 being the previous year, and then 2017 being the current year. So beneath that, we are also given some figures that we are given in terms of interest expense, net profit before tax, income tax, net profit after tax. Then we're also given the second part of the question, which is on auditor support and business ethics. So for the first question, this is information that we have. So remember, we said net profit after tax is the figure that we want, and we see that we have got net profit after tax is 827,000. So this is going to be our numerator. So going to our answer section, we are saying it is equal to 827,000, and then we divide. We try to go back to calculate average shareholders' equity, of which we are going to add the shareholders' equity of the 2 periods, and then we divide by 2. So we come here, we see that shareholders' equity, we have got 5,148,000 for 2017, 3,226,000 for 2016. So add the 2, the answer that we get, we divide by 2 to get the average. So basically, we are saying average, we are just saying half the total of 5,148,000. And then we add the previous year's shareholders' equity, which is 3,226,000. So basically, this is what we have. So if you calculate it like this, you see that you can reduce it to, if you add, you calculate on the denominator, you are going to say 827,000 over. So the average becomes 4,187,000, which gives us the final answer of 19.75% to 2 decimal places. So this is our way in terms of our question 1.1.1. Then moving on to the next one, which is return on total capital employed. So we just need to find out about formula for calculating return on total capital employed. We are going to say net profit before interest and tax as our numerator. Then for our denominator, we are going to have average capital employed. Average capital employed is going to be our denominator. So we can just try to find about net profit before interest and tax as a numerator. So we are given net profit before tax, which means interest was already subtracted, which interest is 135,000. So to get net profit before interest, now we are now saying 1,179,800 plus 135,000. So this becomes our numerator. So we say here it is equal to 1,179,800, and then we add 135,000, which is our interest, which was already deducted. Then over average capital employed. So for our capital employed, remember, we say for our capital employed, we are going to say shareholders' equity plus non-current liability, of which our non-current liability that we got loan here. So we are saying shareholders' equity plus loan. So we get our capital employed. So for 2017 is 5,148,000 plus 800,000. Then we get our capital employed. Then for 2016, 3,226,000 plus 500,000. Then we get our capital employed for 2016. Then we add those two totals, we average those two totals, we divide by 2. So basically we are saying it's going to be half 5,114,000 plus 800,000 for 2017. $5,148,000 plus 800,000. So with that, we get now the capital employed for 2017. Then we add the capital employed for 2016, which is now 3,226,000 plus 500,000. When I simplify it further, it is equal to, we now say if you add all the numerator, you're going to get your total as 1,314,800. So this becomes your numerator, and then we go to the denominator, say half of the total in brackets, and you're going to get your answer is 4,837,000. And then obviously we are supposed to multiply it by 100 over 1. So we multiply by 100 over 1 because it's supposed to be a percentage. You're going to get it as equal to 27.18%. 2 decimal places. So basically this becomes our final answer. And we move on to the next part of our question, which is now 1.2, which is auditor's report and business ethics. So 1.2.1, who is responsible to see to it that the financial statements are drawn up. And we know that the one who draws the financial statements are the employees of the company and represented by the directors of the company. So directors are also employees of the company. So we're going to say directors of the company are the ones who oversee the preparation of the financial statement. So we are coming here. We represent it as directors directors of the company. So this is what we have on that part. We go to the next part, which is saying to which main group of people should the auditors address their report, and why is the report directed to this group of people? So the auditors report obviously should be addressed to the owners of the company, and we know that the owners of the company are the shareholders, so we can just indicate them as shareholders. And then the question goes on and say, why is the report directed to this group of people? In other words, why is the auditors report directed to shareholders? Uh, Simply because shareholders are the ones that are interested in their investments. Remember, the shareholders would have uh, purchased shares from that company, so they've invested in the company. So they are concerned about the performance of the company, which can only be seen in the financial statements, especially through the preparation of the statement of comprehensive income. That's where the shareholders can get to see if the company is making profits or losses. So basically, we are saying they are interested in their investment. Are interested in their investment, hence want to see what recommendations the auditors would have made. So hence want to see uh, want to see which recommendations the auditors will make. So that is what we have on 1.2.2. When we move on to the next part, which is now 1.2.3. The auditor's report refers to the International Financial Reporting Standards. Explain why the auditors have to bring the International Financial Reporting Standards into account when they give their opinion. So the main purpose of the International Financial Reporting Standards is to ensure that the preparation of financial statements is done in a standard way. So in that sense, it can be in the interest of the shareholders as they compare companies when they want to make some investment. There will be financial statements. They will be basing their decisions on financial statements that have been prepared on the same standards. So basically, there is no bias in terms of the comparison that they will make. So this is what we have now, being the main essence that we have that is behind the application of the International Financial Reporting Standard. So we can try to respond by saying uh, it is a requirement of audit standards. It ensures that the financial statements of the company comply with the international standard. For comparison sakes also, we can be also a motive. So we can say it is a requirement. Basically, this is the response that we have on 1.2.3. So moving on to the next part of our question, I would see that according to our question, we can just refer being this is the last question that we have on 1.2. So obviously, we need to move on to the next question according to the question paper. So moving on to our question two. Our question two is got 20 marks. It requires you to spend on average of minutes. So our question two reads: your friend Sibusiso Smith wants to buy shares in a company which sells computers. He asks you for advice and presents you with the following financial indicators of two companies that he is considering. Both companies have the same number of shares. So on the required parts, answer the following questions. In each case, compare and quote the relevant financial indicators, figures, ratios, or percentages of both companies to support your explanation. So on the first part of our question, compare and comment on the dividend payout policy of the two companies. So we need to understand when a question is asking us about the dividend payout policy, we are going to try to find out about the proportion of dividends in our earnings. In other words, we are saying the dividends are per share over the earnings per share, and then you can see what a proportion is being issued out as dividends out of our earnings, and what proportion is being retained in the operations of the business. So basically, with that, we can now be able to explain and clarify on the dividend payout policy. So the question is saying compare and comment on dividend payout policy. So if you go to our answer section, we are going to come up with the explanation within that context. So if you go to our information, you'd see that we are given information of financial indicators of Ladysmith Limited and Dundee Limited, both companies financial year ended on 28 February 2017. So we have got a column that we have for Ladysmith and a column for Dundee. So this is the information given beneath. So we are going to be concerned about the dividends per share, which we are given here, and the earnings per share. So we are given the information in cents, so we can be able to calculate the dividend payouts by saying for Ladysmith, we are saying our dividends, which is 56 cents over our earnings per share, which is 63 cents. And obviously we multiply by 100 over 1 to get the proportionate percentage. So if we calculate it that way, you see that we're going to get it as 89%. Then if you go to our Dundee Limited, our dividends we have given is 46 over our earnings, which is 92. So say over 92. And of course, we're going to multiply by 100 over 1. And you're going to get your answer as your 50%. So obviously, we cannot be able to comment that for Ladysmith, we are having a greater proportion of 89% being issued out as dividends to shareholders. And then a smaller proportion of 100 minus 89, which gives us 11% is only being retained in the operation of business. And if you go to Modern D, we have got 50%, which is half being paid as dividends. And then the remainder obviously is also 50%, which is being retained. So that's how we are going to explain it in our answer section. So we can just we can start by our Ladysmith. So for Ladysmith, we are saying DPS is dividend per share or 50 cents or 56 cents out of earnings per share of 63 cents. Giving us a percentage of 89% in brackets is being paid is dividends. It's only retaining only retaining 11%. So this is what we call the aggressive approach, whereby a greater proportion is paid as dividends, and the main aim usually is to please the shareholders, so that the shareholders are happy. But obviously, it negatively affects the future of the company, as there is no future potential in terms of expansion. If it's a producing company, expansion of its production capacities by the more proportion that has been retained. So that's what we have on Ladysmith. Then we can look at the other one, which is Dundee Limited. Dundee Limited. So on Dundee Limited, we are saying, uh, so we can just refer back to our question again and try to see what that is our question saying. So the question is just saying compare and comment on the dividend payout policy of the two companies. So on the second part, we just also give a summary in terms of the dividend payout policy that we have. So we're just going to say uh, Dundee is paying 50% of its earnings as dividends. Then on 50%, you can just in brackets show the working, whereby we said 46 divided by straight over 92 in brackets as dividends, and retaining also 50%. So this is what we have uh, on our comment on the dividend payout policy. So the question is not asking us to compare between the two, which one is using a better approach. So we can proceed to the next part of our question, which is now saying, comment on the financial gearing of both companies. Explain which company is making more use of loans and state whether it is a good idea or not for that company to do so. So for gearing, when you're commenting on gearing, you are looking at debt to equity ratio. And question is saying, explain which company is making more use of loans. So the one with a higher debt to equity ratio is the one that is using more loans. There, and stating whether it is a good idea, you have to check. You have to compare mainly its return on total capital employed. If it's greater than interest rates, we say it is making it is making more use of loans in a good way. It's a good idea. But if the return on total capital employed is less than interest rate, it's going to be a bad idea. So basically, that's what we have. So we go there again. We're going to look at Ladysmith, and then we'll look at Dundee Limited again. So we can start with our Ladysmith. So for Ladysmith, we are saying the debt to equity ratio. We can just refer back to see what's the debt to equity ratio do we have for Ladysmith. We are given it here is 0.9:1. The debt to equity ratio is 0.9 S to 1. That's the debt to equity ratio. And I will compare the return on total capital employed to our interest rate. And the return on total capital employed, we got 1.2%. We are seeing that it's more than our interest rate. So it's positively geared. So say and return on total capital employed is 21.2% more than the interest rate of 11% according to the interest rate given in the question of 11%. So the question is saying, is it a good idea? So it is a good idea because it is positively geared. And we can just say, therefore, it is a good idea. It is a good idea because of positive gearing. So this is what we have Lady Smith. Then we look at Dundee. So on Dundee, we are saying the is having a debt to equity ratio of 0.52. So we have already identified, according to the person, a spirit company is making more use of loans. So that Lady Smith is the one making more use of loans, and we are saying it's a good idea because total capital employed is more than our interest rate. Then we can just comment on our Dundee, whereby we say it has a debt to equity ratio of 0.5 0.52 S to 1. Debt to equity ratio is 0.52 S2 0.52 S to 1 less than Lady Smith. Less than Lady Smith. We know that Lady Smith is 0.9 S to 1. And if you check its return on total capital employed, again, it's 9%, being less than the interest rate of 11%. So it's negatively geared. So it does not make full use of its debt. So basically, that's what we have on that one. Then we can move on to the next question, which is now 2.3, which is refer to the market price of the shares and the net asset value per share. What advice would you offer Sibusiso Smith about investing in either company? So when investors are choosing, they want a company with a net asset value, which is less than the market price. This is a favorable position. So as we are comparing the two companies to give advice to Sibusiso Smith, we look for a company between the two with a net asset value, which is less than the market price. So we go there and check in terms of Lady Smith. We are seeing that net asset value per share for Lady Smith is 316 cents, which is we can check in terms of its market price. Market price is more 445 cents, which is more than the net asset value of 316 cents, which is favorable. If you look at Dundee, the market price is less than the net asset value. So you'd advise Sibusiso Smith to invest in Ladysmith because of its market price, which is more than the net asset value. So basically, that's how we are going to answer it in our answer section. So we are saying Ladysmith, we have information that market price is 445 cents. And is above net asset value of 366 cents. Then we look for, we comment for Dundee. Say market price market price 315 cents. And is less than net asset value of 342 cents. 342 cents. So in terms of your conclusion is you should invest in Ladysmith. Therefore, Smith should invest in Ladysmith. Yeah, because the market price is greater than the net asset value. So basically, this is what we have on 2.3. So we check it according to our questions. See that 2.3 is the last question that we have on this question 2, and we can as well move to question 3. So moving on to our question 3. Our question 3 is called 30 marks and it requires us to spend on average 18 minutes. So going through our question is the financial year of Mbuso Limited ends on 28 February 2017. The bookkeeper of Mbuso Limited took the year-end adjustments into account and calculated the net profit before tax as 900,000 rands. However, it was discovered that some adjustments were not taken into account and some were entered incorrectly when calculating the net profit before tax. So all the required parts are 3.1 reads calculate the correct net profit after tax for the year ended 28 February 2017. And we see that our question yes, got 7 marks. So you'd see that information that we're given at the beginning is that there is a calculated net profit before tax of 900,000. So it means that this is the amount that we are going to start with in our other section is our net profit before tax at 900,000. So beneath that, we can now make some adjustments. But if we proceed with the information, we are going to see that with our information we are given and the following adjustments and additional information were either omitted or entered incorrectly when calculating the net profit. So we are just going to make these corrections and then we can come up with a corrected net profit, corrected net profit after tax. So we can go error by error. We'll start by the first one, which reads an invoice issued to a debtor for goods sold on credit for 70,000 rands was recorded as a credit note for unsatisfactory goods returned. The markup for this sale was 60%. So we can take note of that. So this is being said it was omitted. Is this saying the an invoice issued to a data for goods sold or carried for 70,000 rands was recorded as a credit note. So it was recorded as a credit note. So let's take note of that. It was an invoice of goods sold on credit, but recorded as a credit note. So what is going to transpire is that when it's a credit note, it means this will be treated as returns. So in other words, returns, it means it was a minus on our revenue. It was supposed to be, it was recorded as a reduction or a minus on our revenue instead of a plus or as an addition to our revenue, since it was an invoice. So basically, we first have to enter 70,000 on the correction of the revenue part for revenue. We are supposed to enter our 70,000 first to remove the 70,000 that has been entered as a credit note. And then we enter again the correct amount of 70,000 which is supposed to be there. So we enter 70,000. It is a plus 70,000 twice on our net profit because the revenue increases. It increases our net profit. So it's going to be a plus if you a revenue increases, it increases our net profit. So it's going to be a 70,000 plus and then a plus 70,000, which gives us a total of plus 140,000. And then also we are seeing whenever we sell goods, we are also supposed to adjust for cost of sales. And we are given the markup as 60%. So basically we are saying, remember we say cost price plus our markup are equal to our sale price. And our cost price is always 100%. Our markup in this context, we're given it as 60%. Then we get our total for 160%. So making a proportion, we now know that 70,000 is our selling price. And the figure that we are looking for is the costs, which is 100%. So make a simple proportion by saying we don't have 100, so numerator over 160. What we have times 70,000. And then we find the costs, which is supposed to be. And then we can try to calculate that one. So we are going to get it as 43,750. So here we've got 43,750. So on cost of sales again, this is going to affect our cost of sales. It's going to be on cost of sales, we are saying it's going to be a negative on cost of sales. Remember, cost of sales increases when you sell goods. So when they are returned, we are supposed to, it's supposed to be reduced. So basically, we are going to reduce 43,750 twice. So we multiply it by 2, we are going to get 87,500. So this is going to be a minus 87,500 on net profit. Cost of sales, we are saying cost of sales reduces net profit. Cost of sales reduces net profit. So basically, that's what we have on the explanation of our cost of sales. So what is going to transpire there is that we are seeing that the effect on net profit is going to be a plus 140,000 plus 140,000 in the form of our revenue. And then for our cost of sales is going to be a negative 87,500. That's the effect that we are going to have. So on our correction, we're just going to put the difference between the two. And we know that the immediate effect is on gross profit. Remember, to get our gross profit, we say revenue minus cost of sales. So obviously, we are going to adjust that on our cost profit, whereby we are going to say, we're just going to say gross profit. Then in brackets, we say plus 140,000, then minus 87,500. So just go there and summarize the such. So here we need to have our gross profit 2,000, and then subtract 87,500. You calculate it that way, you're going to get 52,500. A positive 52,500. So the net effect on net profits is a plus 52,500. Then we can also try to proceed to the next error that we have. So going on to the next error that we have, which is number 2. It reads, according to the profit and loss account, the insurance amounted to 27,000 rands. This amount included an annual premium of 7,200, which was paid on 1 November 2016. So if it was paid 1 November 2016, it is stretching to 31 October 2017. So we need to count the number of months that we have that are outside the current financial period. So if we refer back, we see that our financial period is ending 28th February. So we are going to count from March 2017 to October 2017. So you're saying March, April, May, June, July, August, September, October. So we have 1, 2, 3, 4, 5, 6, 7, 8. 1, 2, 3, 4, 5, 6, 7, 8. So we've got 8 months that are outside the financial period that we need to remove because they do not belong to the current period. So calculating it, we see that the total for the insurance premium is 7,200. So we're going to say 8 over 12 times 7,200. So we see what we get there. So we can try to multiply that one. We'll see that we are going to get it as 4,800. So here we get our 4,800. So 4,800 does not belong to the current period. So what does it mean? It means the figure that was subtracted as insurance. Insurance is an expense. So the figure that was subtracted as insurance in the profit and loss account is greater than 4,800. We need to remove this 4,800. So we over subtracted with 4,800. So to correct that, we have to make an addition of 4,800. So basically, that's how we are going to correct it. So we come here, we say insurance we've got 4,800. Then moving on to the next part, we have from insurance, we can as well try to. So the next one is saying number 3, in the profit and loss account, the amount of rent income amounted to 91,300 rands. The accountant did not take into account that the tenant paid the rent for March 2017 in advance. The rent had increased by 700 rands per month on 1 October 2016. So we have to take note that there is a rent which was received, which doesn't belong to the current period. Remember, the current period is ending February 2017, but we've got a rent for March 2017, which is for the next financial period, which was received in the current financial period. So this is income received in advance. So we need to remove it. It doesn't belong to the period. So we have to find out about the rent for March 2017. What is the amount? We are only given the total for rent, including the March 2017 rent. And we are also told that it increased by 700 on 1 October 2017. So we need to count the number of months before the increase and after the increase. So we say before the increase, it is from March 2016 to end of September 2016. So we are saying before the increase, it was March 2016 to end of September, because 1 October it increased to 1 October. So we say September 2016. Then we count the number of months that we have there. whereby I said March, April, May, March, April, May, June, July, August, September, whereby we have 1, 2, 3, 4, 5, 6, 7. So we have 7 months before. So after, obviously, we say 12 minus 5, 12 months in a year, 12 minus 5, 12 minus 7, you get your 5. So you've got 5 months, the remaining for that financial period, plus the one for March that was also received. So say 5 plus 1, so you're going to get your 6. So it means after we're having 6 months. So we can formulate our equation from that angle. So we can just let the monthly rate before. Assume the monthly rent be capital letter R before the increase. And we can come up with an equation. So we are saying now our equation is going to be before we have got 7 months. So we are saying 7 times R plus after we have got 6 months. 6 months, but it had increased by 700 rand. So it's now R plus 700. And then we get the total that we are given. Total rent received is 91,300. So we can calculate it from that angle, whereby we have 91,300 being the total here. So from there, we can now further calculate our equation, whereby we just remove the brackets, it becomes 7R plus 6 times R becomes 6R. 6 times 700 becomes 4,200 equal to 91,300. So basically, that's how we can simplify it further. So from that now, we can now be able to add the like terms that we have 7R plus 6R, we get 13R. And then 4,200, we take it to the other side, and then it becomes a negative. Now it's 91,300 minus 4,200. 91,300 minus 4,200. And then we get 87,100. 87,100. In other words, we're saying 91,300 minus 4,200. And it becomes 3R. So we can as well try to correct this one. Whereby we put caps R. 13R is equals to 87,100. And then we divide by 13 both sides. It becomes R equal to R equals to 6,700. So this is, remember, R is equal to monthly rent before the increase. And the monthly rent that we are looking for is for March 2017. And March 2017 was after the increase. It had already increased by 700. So we are saying before the increase. So for March 2017, we are now saying it's equal to 6,700. And we add our 700. And we see what we get there. So we are going to get it as 7,400. So we have 7,400. This is for March. This is the one that we need to subtract from the total for our rent received, which is 91,300. So rent, remember, rent increases our net profit. So we need to, which means we over increased our net profit with 7,400. So to correct that, we have to subtract that 7,400. So we come here and we are saying rent income. Rent income, and we're saying it's a minus 7,400. And we can try to move on to the next area that we have. Well, going on to item 4, it is the loan statement are received from Anongoma Bank reflected at the following. So we are given information that we are given, but we already know that there is interest capitalized that we have here of 103,600. So this is a representation of our interest, and we know that interest reduces our net profit. I will go to our correction, and then we say interest on loan. And then the amount that we have is 103,600. It's a reduction. Then we can move on to the next part whereby we are also given income tax for the year amounted to 247,800. So we need also to subtract our income tax, which is 247,800, and we know that it reduces also 247,800. And then from there, we'll check if you still have any adjustment which is going to affect our net profit. We see that we have exhausted everything. So we can try to calculate the net profit after tax now. So here now we've got net profit. Net profit after tax. So we are going to say 900,000 plus 52,500 plus 4,800 minus 7,400 minus 103,600 minus 247,800. And then we get a net figure of 598,500. So basically, this is the calculation that we have in on that part. Then we can try to move on to the next part of our question, which is saying complete the liabilities section of the balance sheet, bracket statement of financial position on 28 February 2017, where notes are not required. Calculation must be shown in brackets for part marks to be end. So notes are not required. Take note of that. But we are completing the liabilities section. So we go to our answer section and then try to see as presented in our answer section. So this is going to be the liabilities section, whereby we are going to start with non-current liabilities. So, and we know that non-current liabilities consist of our loan. And we can see that the loan amount that we have is given here is 794,000. So we can start with our loan. And we go back there. If we check our figure for current portion of loan, remember, current portion of loan reduces our loan balance, and we transfer that amount to the current liability. So according to our question, we are given interest capitalized is 103,600, and then the monthly payments are going to be 15,800 per month. So to calculate our current portion of loan, this is our current portion of loan, we say repayments minus interest capitalized. So it's simple as that. So we are going to say our repayment is 50,800. So it's equal to 15,800 times 12. Because that one is the monthly per month. So for 12 months, we multiply by 12, then we get the total for the year, and then we subtract our interest capitalized, which is 103,600. You see what to get there. So we can try to calculate whereby we are saying 15,800 multiplied by 12. After that, we get you subtract 103,600. and you are going to get your answer is 86,000. So you can just go to our answer section and summarize that. So if you go to our answer section, remember our loan balance is 794,000. Then you subtract current portion of loan 86,000. We do that, we get a final answer is 708,000. So this is what we in terms of our loan balance. And this is only non-current liability that we have. So I'm going to represent again the total for our non-current liabilities. When we go to our current liabilities, so if you come here, let's just try to see according to our information that we are given. We are told that the current ratio for 2017 is 1.5 is to 1. Is 1.5 is to 1. So remember, current ratio is get it by saying current assets is to current liabilities. And then we divide by current liabilities on both sides. So to get the total for current liabilities, we are given item 5, the total current assets amounted to 1,704,000. So already we have our current assets and we're given the ratio, so we can be able to find our current liabilities. So we are saying get our 1.5. This 1.5, yes, 1.5 is supposed to current assets over current liabilities. So current assets is 1,704,000 over our current liabilities. So we want to find our current liabilities by making it the sum of the formula. So it becomes there. So now if you make current liability out of the formula, it becomes a current liability equal to 1,704,000 over 1.5. Then we are going to get your current liabilities as 1,136,000. So this is going to be our total for current liabilities. So this is current liabilities, which is going to come here. Here's our current liabilities, 1,136,000. Then we can now be able to fill in the components of our current liabilities. Then from there, obviously, we have trade and other payables. Trade and other payables. So if you refer back, if you refer back for trade and other payables, you see that there is we don't have information giving us figure for trade and other payables, and even trade creditors, we do not have it. So basically, it means we are going to find it as a balancing figure. So when we come here, we leave it blank, and then we look for other current liabilities that we have in the question. So if you come here, you would see that check for other current liabilities that we have in the question. We see that we have bank overdrafts 500 and bank overdraft 550,000, which we have here. Bank overdraft we have 550,000. We look for if we have got another current liability, see that we only have a bank overdraft. So we come here. Bank overdraft. And we are saying the figure that we have is 550,000. And we also have this current portion of loan. This one is current portion of loan. So it can as well try to include it. It's supposed to be included under current liabilities, whereby we say current portion of loan, where we have 86,000. So having done that now, we see that we have exhausted all the current liabilities, so we can now be able to find our trades and other payables by saying 1,136,000 minus 550,000 minus 86,000. Then we get our 500,000. So here we have 500,000. And then to get our total liabilities, we're supposed to have our total liabilities here. Whereby we are going to say 708,000 for non-current liabilities plus current liabilities 1,136,000. And you're going to get your answer is 1,844,000. So that's what we have for that part. We refer back in terms of requirements of the question. Right, on the next part is saying prepare the following note to the balance sheet statement of financial, or that is statement of financial position, order share capital note with 9 marks. Order share capital note. So we refer to our other section to see this is our order share capital note. And obviously, we can as well try to create another column whereby we are going to put the number of shares. So we are going to start with our opening balance of order shares. So refer back to the question. You see that order share capital is a question mark, but we are having it pre-entered in our answer section as 2,400,000 is the value for our opening order shares. So here we are saying order shares, and this is our opening balance order shares. So having done that now, we check the number of shares that we have in terms of our open order shares. We can get the information on 8, whereby say on 1 March 2016, at the beginning of the year, the ordinary share capital amounted to 2,400,000 is entered, and then 60% of the authorized share capital of 500,000 were issued. So it means number of shares in issue is 60%, which is 0.6 as a decimal. We multiply by 500,000 authorized to get the number of shares in issue. So if you calculate to see that, you're going to get your answer is 300,000. So we come here, you see that we have 300,000 this side. Then we check our movements in terms of additions of shares issued during the year, and also repurchase. So you're told that on 1 July 2016, the directors issued an additional 100,000 shares at 8 rand coins. So we've got all the shares issued at 8 rand coins. Shares issued at 820, and we have 100,000 shares. By incorrect, we'll just check. There we have got 100,000, yes. So to get the value, we now say 100,000 times 820, and you get 820,000. Then moving on, we are also told that on 10 January 2017, the directors decided to buy back 70,000 shares from the estate of a deceased shareholder at R8.60 per share. This transaction was completed successfully, but no entry has been made. So the most important thing is that we have got 70,000 shares we are repurchased, and whenever there's a buyback, we indicate it as a negative. So we come here, we say 70,000 shares were repurchased, and then it's a subtraction. And we give the description that shares bought back and so the value that we put, the value per share that we put in ordinary share capital note is the value at average share price. Shares are bought back or repurchased at average share price. We can take note of that. They are bought back at average share price. So whenever there's a repurchase or buying back, we should consider the average share price. So the share price that we are given here is that they were bought back at R8.60 per share. Is not the actual per share amount that we should put in the ordinary share capital. We should calculate the average share price. That's the one that we put in. So how do we calculate that one? We say the value of the total value of the shares before the repurchase or before the buyback. For instance, here we have got 2,400,000 as our opening, plus further 820,000 that were issued. So we're going to say our numerator will be 2,400,000 plus 820,000. And then this becomes our numerator. Then we divide by total number of shares that we have again before, which is 300,000 at the beginning, plus 100,000 of new shares issued. So we're saying 300,000 plus 100,000. So this is how we are going to calculate it. So for our numerator, if you say 2,400,000 plus 820,000, let's just try to calculate and see what we get. 2,400,000 plus 820. Get 3,220,000. And obviously we are going to divide it by the total for the denominator, which is going to be 400,000. Then we get the average share price. So we're not going to say 3,220,000 and divided by 400,000. Get 8.05, which is 8 rand 5 cents. This is the average share price. So this is the one that we are going to use here is our average share price. 8 rand 5 cents. Then the value now, we are now saying 70,000 times 8.05. And then we add 70,000 multiplied by 70,000. We're going to get is 563. About 63,500. And we show it as a negative since it's a repurchase. Then we can now be able to find the final balances, whereby we can start with the column for number of shares, 300,000 plus 100,000 minus 70,000, and we get 330,000. Then in this column, we are saying 2,400,000 plus 820,000 minus 563,500, and we get 2,656,000. 2,656,500. this becomes our ordinary share capital note that we have. So we can so take note of that. So referring back to our question, so this becomes the last part that we have in terms of our 3.3, and you see that it has 9 marks. So with that, we can now move on to the last part of this question paper, which is our question 4. So moving on to our question 4, it is 30 marks and requires you to spend on average 18 minutes. So our question is, you are provided with an extract from the financial records of MG Limited on 20th February 2017, which is the end of the financial year. They are authorized to issue 1,200,000 shares. By 28th February 2017, they had issued 540,000 of these shares. So all the required parts, first part, it is complete the reconciliation of net profit before tax and cash generated from operations 28 February 2017. Our question is 9 marks, so you can just take note of that. So we can start with our 4.1, whereby we are also given additional information A, extract from the income statement, and also balances extracted from the balance sheet for 2016, which is the previous period, and 2017 representing the current period. So beneath that, we are given fixed assets, and then we have got share capital dividends. So basically, that's what we have. So moving on to another section in terms of reconciliation of net profit before tax and cash generated from operations. We are going to start with the figure 4, net profit before tax. So we can start with our net profit before tax. So here we'll see net profit before our tax. So obviously we refer back to see where can we get that information for net profit before tax. So we are given net profit after tax 1,260,000, while the income tax is 540,000. So net profit before tax, we are going to add 1,260,000 plus 540,000. Remember, to arrive at net profit after tax, we say net profit before tax, net profit after tax is equal to net profit before tax. We make the sum of the formula, and it becomes net profit after tax plus tax. So basically 1,260,000 plus 440,000. So we summarize that in our other section. We're going to say 1,260,000 plus 540,000. And then we get 1,800,000. And then we look for a depreciation. If you give me the question, we see that we're given depreciation as a question mark. We are given our depreciation as the question mark. So we can try to find out where can we find our depreciation. We're going to our information C, where we've got our depreciation being stated. It is equipment purchased on 1 March 2014 for 80,000 rands was sold on 31 August 2016 for cash at the carrying value. Depreciation on equipment is calculated at 15% per annum or diminished method. So basically, the depreciation that that is being stated on information C is for the equipment that was disposed. So we cannot get the depreciation for the whole period, but if you go down, see that we have gotten inserted additional information of E, which is saying depreciation for the period is 145,788. So we can take that as our depreciation for the period. So remember, in our reconciliation, we are trying to remove non-cash items like depreciation, as we are going to prepare the cash flow statement. Remember, in the cash flow statement, we only record actual movements of cash in and out of the business. So in terms of depreciation, it's a non-cash item. So there's no movement of cash. That's why we are readjusting it. Remember, initially in the profit and loss account, we regarded the depreciation as an expense and we subtracted to get our net profit. But in this case, we are adding it back so that we remove it. So basically, that's what we have. Then if we have any other non-cash item that we have in the question, we also adjust it so that we remove it. So, but this is the only one that we are having of depreciation. Then we move on to, we'll try to check if we have got interest. Interest expense also needs to be adjusted. Remember, interest expense are for procedure, for disclosure procedures. We are supposed to remove it when we are preparing the reconciliation, but we reinstate it or readjust it again in the cash flow statement under operating activities. So this is just a disclosure procedure, but it's a cash item. Interest expense is a cash item, but for disclosure procedures, we initially remove it in the reconciliation, and then we reinstate it in the cash flow statement under operating activities. So we are having interest expense being 89,600. So remember, initially we had subtracted it under the income statement. So to remove it, we add it back. So we come here and we are saying interest expense. We're having 89,600, whereby we are adding it back. Then from there, we can now be able to find the net profit before changes in working capital. Net profit before changes in working capital. So we just add here 1,800,000 plus 145,788 plus 89,600. And then we get to 2,835,388. And then from there, we are supposed to adjust for changes. Changes in working capital. So the net change in working capital is going to come here. Then we can adjust for changes beneath that. So for changes in working capital, an increase in our current assets is shown as a negative. So the opposite is true, a decrease in current assets, I will show it as a positive. So the opposite is true also for current liabilities. An increase of current liability is a plus, a decrease in current liability is a minus. So we can just take note of that. Then I believe that we can start by looking at the components of working capital. Remember, to calculate working capital, was current assets minus current liability. So components of current assets and current liabilities are the ones that we are looking for, and we analyze the changes that we have in terms of those elements. So we come back here, going down, we see that we have got, we can notice debtors first here as an element of current assets. So from 2016 to 2017 for debtors, we see that there's a movement that we are seeing here. That is from 288,600 to 238,600. We are seeing a decrease. We are seeing a decrease. And when it's a decrease, as we have analyzed, when it's a decrease of current assets, it's supposed to be shown as a positive. So we just calculate the decrease whereby we're saying 288,600 minus 238,600. So summarize that working in debtors, whereby we summarize the decrease. By saying 288,600. Then we subtract we check there in terms of so what we are going to do is we are going to notice the change in terms of trade debtors and other receivables. So we can take note of that. We can just call that uh, trade and other receivables. So we have got trade debtors being our trade receivables. The other receivables that we have, we've got prepaid expenses. We also have check if you've got any other receivable that we have. We only have a prepaid expenses that we have as part of other receivables. So we don't say 238,600 plus 31,200 for 2017. So for 2016 is 288,600 plus 24,800 of prepaid expenses. So come here we say plus 288,600 plus 24,800. 24,800. Then we subtract 238,600 and we subtract again 31,200. So we can as well try to calculate that one. And you're supposed to get a net amount of 43,600. That's indicating a decrease, which is supposed to be shown as a positive. Then we check again other components of working capital. We have got trade creditors. Trade creditors is part of trade and other payables. So we've got trade creditors and other payables. We have got income received in advance. It's also a trade payable. So it means we can as well try to see if we say 490,000 plus 47,800, what are we getting to see the balance for 2017? We say 490,000. Then we add 47,800. We're going to get it as 537,800. Then with other payables for 2017. For 2016, I will do the same thing. We have got 410,000 plus 59,200. Sorry, for trade creditors, we have got yes, 410,000 plus 59,200. You get 469, 200. And we are seeing that is a movement from 2016 to 2017, which is also an increase. And we have analyzed an increase of current liability. Trade and other payables is a current liability. An increase of a current liability, we said it's a positive. So by how much is what calculation that we would want to make, whereby we say uh, these are now our trade and other payables. Trade and other payables, whereby in brackets we say 537,800. And then we subtract 169,200. So what do we get from that? Get 68,600. 68,600 and you say it's a positive. So I'm going down again and checking what else do we have next. From our trade creditors, we go down. We've got also inventory, whereby it's a movement from 248,000 to 324,000. So it's an increase of a current asset, which should be shown as a negative. So we say inventory. For our inventory, we are saying 312,000 minus 248,000. So we calculate it, I'll see that we're going to get a net figure of 64,000, which is supposed to be negative. So to get now the net changes in working capital, we are saying 43,600 plus 68,600 minus 64,000, and then we get a net figure of 48,200 positive. Then we can as well try to add it to our net profit before changes in working capital. 2,035,388 plus 48,000 plus 40,200, we get a total of 2,083,588. So this is now the cash generated from operations. The one that we are calculating here, we are calculating cash generated from operations. So this is the figure that we are going to take to our cash flow statement. So the next item is cash flow from cash flow statement on period February 2017, whereby we start with cash flow from operating activities. So cash flow from operating activities, we start with cash generated from operations. We've already calculated that one. So what is the figure for cash generated from operations? We have it here, 2,083,588. 2,083,588. So that's what we have on that one. Then we look for other operating activities that we have. Remember, we are supposed to readjust our interests paid, which we also adjusted in the calculation of cash generated from operations. So we are saying interest paid, which is obviously an outflow. And we are seeing that it was, we adjusted it here as 8,600. So here we're going to show it as a negative now, as an outflow. So we say 89,600. And then from our interest paid, we are also supposed to adjust for tax and dividends. So we can start with dividends. Dividends paid. So we go back to see how can we calculate dividends paid. So for dividends paid, we are going to calculate it as equal to interim dividends. This is an alternative calculation. Interim dividends plus previous. We can just maybe try to present it as opening balance of shareholders for dividends. So the opening balance for shareholders for dividends, we already have it here. Shareholders for dividends, which is for 2016, is the opening balance 140,000. So we are saying we already have 140,000. So we are saying already it's close to 140,000, which is opening balance of shareholders for dividends. So the one that we want to look for is the interim dividend. So interim dividend, obviously, we are given total dividends for the year ended 20th February 2017, which is 225,000. And we know that total dividends is equal to interim plus final. Interim plus final. So we need to calculate the final one. Since if you go to our list of balances, the question mark represents the final dividends, which is not given. So we need to calculate it. And when we find it, we subtract it from total dividends, then we get interim dividends. So our final dividends is 12 cents. 12 cents have been declared on 20th February 2017 at the end of the year. So how are we going to calculate it now? We are going to say 12 cents, that's the number of shares that we have. So we have 900,000 shares issued at the beginning, plus 125 that were further issued. And then we have got 70,000 ordinary shares which were repurchased. But there are no emphasis that these shares do not qualify for final dividends. So we are not going to include them in the calculation of final dividends. But we know that is 12 cents per share. So we're going to say the answer that we get here multiplied by 12 cents, which is 0.12. So we will try to calculate it from that context. We're saying 900,000 plus 125,000 first. And then the answer that we get multiplied by 0.12. And we're going to get it as 123,000. So 123,000 is the final dividend, but total dividend is 225,500. Then we subtract to get our interim. So we are saying interim is equal to 225,000 minus 123,000. And we are going to get it as 102,000. So having that is our, remember this is 25,500, so we can just correct that one. Here is 25,500. Then we subtract 120,000, we get 102,000. We get 102,500. So we can as well correct that part. So that is what we have. So this becomes our interim. So to get our dividends paid, remember we said interim dividends plus our opening balance of shareholders for dividends, of which 140,000 plus 102,500. Then we get our final dividend. So this is how we are going to summarize it in our other section, whereby we are saying dividends paid in brackets 140,000. Then we get 102,500. Then we get a total for the total that we get is 242,500. And we know that this is an outflow again, so it is a negative. And then next we have to find the tax paid. Or we can as well try to refer back see how can we calculate our tax paid. So to find our tax, we should come up with a SARS income tax account whereby we have debit balance as our income tax at the beginning, or it will be under current assets on the debit side. And then if it's a credit balance at the beginning or it's under current liabilities at the beginning, this is beginning and this is also beginning. If it's a current liability or a credit balance at the beginning, it's on the credit side. So the opposite is true for a debt balance or current assets at the end to be on the credit side. Or we are saying credit balance for under current liability at the end to be on the debt side. And then taxation for the tax for the period will be on the credit side. So the figure that we are looking for, we get it as bank as a balancing figure on the debit side. So basically that's how we should come up with our SARS income tax. So we can as well try to calculate it from that context, whereby now we are saying according to our SARS income tax, we've got 2016 being the beginning, 2017 being the end. So we are saying at the beginning, we've got a debt balance of 17,520. So we have a year, 17,520. So that's what we have on that part. And then we try to look at the other balance given, which is now at the end, it's a credit balance at the end. Credit balance at the end is on the debt side. You see now, and we've got an amount of 13,400, 13,500 and 13,540. So we are saying 18,540 for the debt side. Then the tax for the period, we check it. Tax for the period, we see that income tax we're given it is 540,000. So yes, check it here, 540,000. So this is the tax for the period, which is this one on the credit side. So we come here, we say 540. So to get the one bank, the figure that we are looking for, it should come on the debit side as a balancing figure. We are now saying 540,000 minus 17,520 minus 30,540. Then we get your answer. So we summarize that in our answer section for tax paid, whereby we are saying 540,000 then we multiply, we subtract 13,540. Then we subtract again 17,520. And then we get an amount of 508,940. 508,940 is an outflow again. Then we can now be able to find quick cash flow from operating activities by saying 2,083,588 minus 89,600 minus 242,500 minus 508,940. And then we get a net figure that we are supposed to put there as our cash flow from operating activities are being 1,242,548. Is a positive. And then from there, we can move on to cash flow from investing activities. We've got purchase of fixed assets being pre-entered. So we are going to look for other, whereby we proceeds on sale of fixed assets. Proceeds from sale of fixed assets. So we come here. So on proceeds from sale of fixed assets, we are coming to information C. That's where you can be able to see the proceeds. So it reads, equipment purchased on 1 March 2014 for 80,000 rands was sold on 31 August 2016 for cash at the carrying value. So very important, it was sold at carrying value. And depreciation on equipment is calculated at 15% per annum on diminishing balance. So we need to count the number of periods that we have until it was sold so that we can be able to find the carrying value. Remember, the carrying value is equals to cost minus accumulated depreciation. This is the formula. So we need to come up with the carrying value on the day of disposal. So you can be able to find the proceeds on the sale of that equipment. So 1 March 2014, remember our year is ending 28 February. So it seems from 1 March 2014 to 28 February 2015 was the first period. So we can just summarize the periods. 1 March 2014 to 28 February 2015 was the first period. So the second period, 1 March 2015 to 28 February 2016. Third period, 1 March 2016 to 28 February 2017, which is the current period, this one. So we need to calculate depreciation for the first year until you reach the third year. So for the first year, we are going to say it was purchased 1 March 2014. So it stayed the whole year. So we are going to say our percentage, which is our percentage, we're given it as our percentage we're given it as 15% per annum. So it's going to apply for the whole year since it stayed 1 March 2014 when it was purchased to 28 February 2015. 15% of 80,000 for the first year. So we are saying for first year, second year, and third year. So for the first year, we are saying 15%, 0.15 as a decimal, multiplied by the cost, which is 80,000. And let's calculate and see what do we get there. So we are going to get it as 12,000. So it means for the first year, we got depreciation for 12,000. Then for the second year, depreciation, remember, to calculate depreciation, we say using diminished balance method, we say percentage times carrying value. Where carrying value is cost minus accumulated depreciation. So in this case, second year, the accumulated depreciation that is only there is 12,000. So we're going to say 0.15 times in brackets 80,000 minus 12,000. And then we get, so first to say 80,000 minus 80,000 minus 12,000, and we are going to get it as 68,000. Then we say 68,000. 68,000 times 0.15. 0.15. And we get 10,200. So it means second year depreciation was 10,200. Then for the third year is the one that we are in, the current year. We say 0.15 times 80,000 minus accumulated depreciation, which is now 12,000 plus 10,200, which is now 22,200. So first we get the carrying value by saying 80,000 minus 22,200. And you get 57,800, and then you multiply it by 0.15, which is 8,670. But this depreciation is for the way we want the number of months that it stayed for the last period, which is it was disposed on on 31 August 2016. And we know that our year is starting 1 March 2016. So we're saying March, April, May, June, July, and the whole of August. So we got 1, 2, 3, 4, 5, 6. So it stayed for 6 months for the last period. So we are going to say the answer that we got for depreciation for the whole year times 6/12. And the year we multiply by 6/12. In other words, we just divide by 2. And we see that depreciation for the year of disposal is 8,670 times 6/12. We get 4,335. So that makes us now to calculate the carrying value on the disposal day. So we are now saying 80,000 cost minus accumulated depreciation, which is depreciation from the day of purchase to the day of disposal. 12,000 first year is our depreciation plus 10,200 second year plus, sorry. And we also add for the last period is 4,335, which is equal to 80,000 minus so we are saying for total depreciation, which is accumulated depreciation 4,000, we add 10,200, we add 4,335, and we get 26,535. Then the carrying value becomes the carrying value becomes 53,465. So this is the carrying value on the day of disposal, and it's being said that it was sold for cash at the carrying value. So the carrying value is this one. So this is the proceeds for the sale of the equipment. So we come here. We are now saying proceeds on sale of fixed assets. And then we got 53,465. It is a positive because it's inflow. Then those are the two that we have for investing activities. So we can add the two, negative 229,620 plus 53,465, and you get your answer is 176,155. So that's what we have there. Then move on to the next part, which is now cash flow from financing activities. Next, cash flow from financing activities, we are going to check in terms of if there are shares that were issued, etc. So we can as well try to see in terms of shares issued and repurchase of shares. Those are the typical items that we put under financing. So we can only be able to know about it under share capital dividend. So we are told that the company issued 125,000 owner shares at 13.20 per share. So to get the value of issue, we are saying 125,000 times 13.20. 125,000 times 13.20. So we come here and we say proceeds on shares issued. Then in brackets, we just summarize working 125,000 times 18 rand 20, 18 rand 20, which is our 13 rand 20. So we multiply, you see that we get 1,650,000. 1,650,000. Then we check in terms of repurchase. We are also told that 75,000 ordinary shares were repurchased from the estate of a deceased shareholder at 310 above the average price. So we need to find out which is the average price now. So we can take note that that to get our average price, we've actually put the formula in terms of the previous question, whereby we say average price is total value of shares before the repurchase or the buyback over total number of shares before the buyback. So in this case, for our numerator, we are going to say the number of value of the shares before purchase. We have the value at the beginning, 4,500,000. So we are saying 4,500,000 plus additional shares issued, which we calculated as 135,000 times 13 rand 20, and we got 1,650,000. So we get 1,650,000. And then we divide by the total number of shares before the buyback, of which we have 900,000 shares at the beginning plus 125,000 shares that were issued. So we are going to say now the shares that we have, 900,000 plus 125. Then we get the average share price, whereby we say for the numerator, we are going to say 4,500,000 plus 1,650,000. And we are going to get it as 6,150,000. And then we divide by 900,000 plus 125,000. And you get 1,025,000. So you can be able to find the average that we have. So we divide there. We see that we are going to get it as 6. So it's going to be 6 rand per share is the average share price. Then we have put an additional, which is 3 rand 10, which is above the average share price. So 3 rand 10 now it becomes the repurchase now it becomes 6 rand plus 3 rand 10, and we are going to get it as 9 rand 10. So this is the one that we are going to multiply with 75,000 of repurchase. So in brackets, we are saying, remember the description is buyback of shares. And in brackets, we just show the working by saying 75,000 times 9 rand 10. and we get an amount of 682,000, 682,500. And this is in brackets because the repurchase is negative, it's an outflow. So this is what we have on that part. And we still have we check in terms of loan movements. What do we have? For loan movements, we can come here. We see that loan was 665,000, 665,600, and then it decreased to 652,000. So the decrease represents a repayment of loan. So we can just say repayment of loan, or we can just indicate it as decrease in loan. Where in brackets we are saying 665,600 minus 652,000. And then we get a net figure of 13,600, which is a repayment, and the repayment indicates a negative again. So this is what we have on that part. And we've concluded the details of cash flow from financing activities. So the net, we're going to say 1,650,000 minus 682,500 minus 13,600. And then the final answer that we are supposed to get is 950, 953, 953,600. So from there, we can now proceed so that we can conclude the cash flow statement. So we can try to verify the calculation that we have here. That is going to lead us to 953,900, and so we can just try to verify the calculation. So we have 953,900. Then having that now, we can now be able to try to see in terms of net change in cash and cash equivalents now. So in particular, if you come here, it's going to be net change. Net change. Net change in cash and cash equivalents. So we can try to find out what do we get there. Right, so to get our net change in cash and cash equivalents, we are going to start from cash flow from operating activities, 1,242,548. And we see that this figure that we got from investing activities, it was a negative plus a positive, and the final answer that we got here is a negative. So we are saying 1,242,548 minus 176,155 plus 953,900. So we can just try to calculate it from that angle and see what we get. So our net change in cash equivalents becomes 2,020,293, which is our positive. And then we look for uh, change in cash and cash equivalents. We can just see it cash and cash equivalents. Cash and cash equivalents. That is at the beginning. So we refer back, you see that in the beginning, we are having cash and cash equivalents 91,200, and then bank overdraft is 126,390. So the balance we are saying 91,200 minus 126,390, and we get a negative 35,190. So here we say a negative 35,190. Then from there we get now cash and cash equivalents at the end. At the end, to get the cash and cash equivalents at the end, obviously we can just rewrite that in the last row. Whereby we are saying cash and cash equivalents at the end. We are given it as we got it is now 2,020,293 minus 35,190. We try to see what do we get there. We are going to get 1,985,103. So basically that's how is our cash and cash equivalent in the end. So this marks at the end of our cash flow statement, and this is the last question that we had on this question paper. So thank you for listening, and hopefully the video was helpful. And please let's not forget to subscribe and share to our channel, and share the link to our colleagues who are doing great co accounting. Let's meet again in the next video.